investment returning less than around 5% annually, that is the inflation rate, is effectively losing your money in real terms. This is exactly why a savings account around 3 to 4% isn't enough, and why equity investing historically 12 to 15% over long periods makes sense for a young person with time on their side. So let's say I want to invest in an SIP. How does one assess a good mutual fund to invest in? What are the parameters? Explain very simply, right? This is the prompt I gave to Claude, and you can see the answer. So the key parameters to assess a mutual fund, firstly, is returns. That is the past performance. So check returns over 1 year, 3 years, 5 years, and 10 years. Longer the track record, more reliable the signal. Past performance doesn't guarantee future returns. You should be careful in that. So this is a warning. But consistency matters. And compare it against its benchmark. For example, Nifty 50. If the fund can't beat its benchmark consistently, why not just buy an index fund? Now, second is expense ratio. The annual fee the fund charges you expressed as a percentage. So lower expense ratio is better because even a 1% difference compounds into a huge amount over next 20 years. For example, index funds have expense ratio around 0.1 to 0.2%, and active funds have slightly higher expense ratio around 0.5 to 1.5%. Now, third parameter that we're looking at is fund size. That is AUM, that is assets under management. So assets under management basically refers to the total money that the fund manages. If it is too small, it is a risky fund. That is, it might shut down because it is very small. If it's too large, it can become difficult to manage as well, because then it's a lot to manage, right? A sweet spot is generally around 1,000 crore rupees plus for equity funds. Now, fund manager track record is another parameter. Who is running the fund and for how long? So you study the track record, study their history, and has the same manager delivered consistent returns, or did the fund do well under a previous manager? You have to check that out as well, and research the manager changes, right? And manager changes are actually a red flag worth watching for whenever you're looking at funds, different funds. Then fifth parameter is risk ratios. Sharp ratio measures return per unit of risk taken. Higher the sharp ratio, it is better, means the fund isn't just taking wild bets to get returns. Standard deviation, how much the fund's returns fluctuate. Lower is a more stable, low standard deviation is more stable. Don't stress too much about these as a beginner, but good platforms show them clearly, right? Now, portfolio concentration. So, what stocks or sectors is a fund heavily invested in? If 40% is in one sector, for example, IT, you're more exposed to that sector's risks, right? And a diversified portfolio across sectors is generally safer. Now, consistency, rolling returns. So, did the fund do well only in one great year or consistently across market cycles? A fund that gives steady 13% year on year is better than one that gives 30% 1 year and minus 10% the next, obviously. Now, where to check all of this for free? So, you can check it on valueresearchonline.com, the gold standard for mutual fund research in India. Morningstar India or also Grow or Kuvera, these apps both show these metrics clearly in simple language. You can go and refer to these websites and these apps.